Today we're diving into RenaissanceRe. They're a global reinsurer that's basically mastered one of the riskiest businesses on the planet, insuring catastrophes. For any investor, this is a really fascinating story about risk, reward, and, you guessed it, resilience.
And it all kicks off with this number. In 2024, RenaissanceRe, or R&R as we'll call them, posted a record-breaking operating return on equity of 23.5%. Now let me put that into perspective for you. For a company in the insurance game, that kind of return is just exceptional. It blows the industry's cost of capital right out of the water.
So you got to ask yourself, right? How on earth does a business that's built around the world's worst disasters pull off numbers like that? And maybe more importantly, in a world where risks just seem to be getting bigger and crazier, can they keep it up?
Well, the answer seems to lie in a pretty unique business model. Insiders and analysts love to call it a three-legged stool, which is a perfect metaphor for a company that's all about stability and balance.
So, what are these three legs? First, you've got underwriting income. That's the high-risk, high-reward heart of the operation. Second is fee income, a really nice steady stream of cash. And third, investment income, which is what they earn on all the money they hold. Let's break down how each of these legs did in 2024.
All right, leg number one, underwriting income. It brought in a whopping $1.6 billion. This is mostly from their property business, the part that insures against the really big stuff like hurricanes and earthquakes. It's a huge profit engine for sure, but it is incredibly volatile.
Next up, fee income, which delivered a very steady $327 million. This comes from their capital partners business, where they manage over $13.5 billion for other people. Think of it as a high-margin, low-risk business that gives them a profit stream that has nothing to do with their own underwriting risk. It's a great diversifier.
And the third leg, investment income, was actually the biggest of them all, at $1.7 billion. This is pure gold. It's the money they make off their float, that giant pool of cash they get from premiums long before they have to pay any claims. And in a world with higher interest rates, well, this leg becomes an absolute powerhouse.
So here's the magic. It's how these three parts all work together. The steady, predictable cash from fees and investments acts like a giant shock absorber. It provides this incredible cushion against the wild swings you're going to get when you're in the business of insuring natural disasters. It really is a self-reinforcing system built for resilience.
But, and there's always a but, isn't there? That resilience is getting tested constantly because this powerful profit engine is facing down two absolutely massive threats that could, in theory, knock the whole stool over.
Threat number one is climate change. No surprise there. This is a physical risk. More frequent, more severe natural disasters hitting their core property business right where it hurts. The second threat is something called social inflation. This is a whole different beast. It's a societal risk. Basically the growing trend of U.S. juries handing out enormous multi-million-dollar verdicts. This verdict inflation is a direct hit to their long-term casualty business. Now here's the real kicker. What makes R&R so unique is that they have massive, world-leading exposure to both of these risks at the very same time. They're a top player in dealing with crazy weather, and now they're a top player in dealing with unpredictable U.S. juries. Trying to manage both of those huge, evolving risks at once, well, that's the whole challenge right there.
So, that's the theory. But how does this supposedly resilient model actually perform when things go wrong? Let's look at a real-world stress test from the first quarter of 2025 and see what happened.
Okay, so in that quarter, the California wildfires hit, and they hit hard. R&R took a massive underwriting loss of $771 million. Ouch. But in that exact same quarter, their investment income was a positive $738 million. Just look at that. It's the system working perfectly. The ballast kicked in and created an almost perfect offset. And the result of that offset? This is the wild part. The company's tangible book value per share, which is really the key measure of value for shareholders, it actually went up. It grew by almost 1%. Think about that. Even after one of the worst disasters you could imagine, the business model not only protected but actually grew shareholder value.
And just so we're all on the same page, for an insurer, tangible book value per share, or TBVPS, is everything. It's the North Star. The goal is just to grow it, year in, year out, through thick and thin. The fact that R&R kept it growing even after a major cat loss, well, that says a lot about the power of their model.
Okay, so all of this brings us to the big finale, the investor's dilemma. We have what looks like a best-in-class company with a super resilient model, but it's facing these gigantic risks. So how is it valued?
Take a look at these numbers from October 2025. You can see R&R's return on equity is fantastic, right near the top of its class at about 18.8%. But then look at its price-to-book multiple. It's just 1.2 times. That's a huge discount to its major competitors like Munich Re, Swiss Re, even Arch Capital.
Now, Investing 101 tells us that a company that earns higher returns on its capital should trade for a higher valuation. It just makes sense. So why isn't R&R? Well, it seems the market is just really nervous about all that risk we talked about.
And that boils everything down to this one single question for an investor. Is the market right to be so cautious to apply this big discount for R&R's exposure? Or is it totally overlooking the proven resilience of that three-legged stool, and in the process undervaluing one of the best operators in the business?
Well, we don't have to guess what management thinks. They've made their opinion crystal clear. They've bought back over $1.4 billion of their own stock in just the last 3 quarters. That's them putting their money where their mouth is and screaming that they think their stock is cheap.
So that's where we'll leave it. Is RenaissanceRe a discounted champion that the market just doesn't fully appreciate yet? Or is its huge concentration in the world's biggest, scariest risks just a time bomb waiting to go off? Answering that is the multi-billion-dollar question.